Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, back with another stock overview, one that I've been watching closely, have taken positions in various portfolios. It is a volatile one for you. I think there's a lot of potential if you've got the stomach for this. So we shall see. It's Sibanye Stillwater. Deep dive today, and I'm going to give you my thoughts. So disclaimer, nothing that I say here is advice. It's just me sharing my thoughts with the world. So you have been warned. If you listen to me, you are as crazy as I am. So one little note from the sponsors, and the Maverick Life portfolio is a publicly shared portfolio that premium members have access to in my Substack. The link is below. It's a yield income portfolio. So different to the eToro portfolio, my private wealth portfolio, which is about deep value investing and realizing that over time. This one is a small spin-off, let's call it, which is focused on yield, helps me to get income no matter where I am around the world, because we do need income from time to time, has been known to help, let's be honest. Executive summary. So Sibanye Stillwater operates in mainly South Africa. They do have some operations in Australia, US, and Europe. They're mainly focused on PGM, so platinum group metals, and rhodium, which is something I know nothing about. They do have some precious metals and uranium as I guess a byproduct, for want of a better word, from their particular mines. So platinum group metals are very, very interesting. They are currently due to enter a supply deficit. We've seen a recent price meltdown, I would call it. And the idea behind that is that the Russians are using what they have to sell onto the open market to gain external sources of hard currency. That would be a lot of platinum and palladium. And so that would be potentially a perfect storm for the platinum group metals. So you've got a supply deficit on the horizon, yet weak sentiment near term due to price, and that famous saying that sentiment is really just a 3-month average of the trailing price. I think we're really at a stage where the supply starts to become constrained whenever the Russian selling begins to abate. In addition to which, on the demand side, this delay in transition to the electric vehicle narrative that we're seeing means a prolonged use of internal combustion engines. And of course, they require catalytic conversions. And the main use for the platinum group metals still currently is catalytic conversion in internal combustion engines. Precious metals, of course, likely to benefit from a loosening in fiscal policy and monetary policy required to patch up fiscal policy and crazy deficit spending around the world. So we look good from a precious metals perspective. And Sibanye also reports 71 million ounces of precious metal reserves, or platinum group metal reserves, 390 million ounces of resources, and a wild card here, 66 million pounds of uranium, apparently, which everyone seems to be ignoring. Yes, it will cost a lot of money to get out, but that's the idea in a nutshell. The thesis, well, how am I going to make money out of this potentially? The sector's been smacked down for the reasons that I mentioned. I think it's going to be a patience game. I think 26, more so than 25, we'll start to see the metals move, just purely because things always seem to take longer than I expect. Sibanye has operating torque to these metals because it's a reasonably high-cost producer outside of their South African operations. And they have essentially this weird call option on uranium. If my Uncle Rick was here, he would say that he loves hate. He likes to buy hate. Sibanye is so hated right now, so hated. And so the easiest money in the world, as Uncle Rick would say, is to ride the return from hated to merely tolerated. That's what I'm hoping to do with this particular trade or investment. This is a net asset valuation that I'll be using. I'm looking to buy inventory in the ground that I think has a certain value, and I think has a reasonable time frame for which that valuation or price realization will occur. So it's currently trading at 60% of its net asset value. It has no net debt. It has plenty of liquidity to ride out the next few years to get that reversion to NAV, and most likely overshoot, because that's the way these things work. If we do really see a bullish price environment for the metals which they sell, And then the leverage and the operational torque that the company has means that they are likely to get an inflection point and accelerating growth in their cash flows. In addition to which, their reserves obviously grow in value because the prices at which those reserves in the ground will be valued will obviously go up. It's kind of a hedge against my oil thesis. I don't think it's a great hedge, but essentially, if you're looking at a metals and mining company, its number one cost is diesel for extraction of the metals. So if we do have a sideways or softer oil environment than I expect, then potentially that could be bullish for the margins of Sibanye. Now, it's a very long bow to draw, but it's just another consideration that I wanted to put. Now, bear in mind, this has been taken from the company corporate presentation, so, take it for what it's worth. However, there does seem to be quite a bit of consensus around from 25 or maybe 26 onwards, we're going to enter into, we're really going to enter into a deficit for these particular metals, reasons that I mentioned earlier. And so let's take a look at the company on one page. So I like this setup. It gives me information in one view. Price action's terrible. It's been down 45%. I mean, as of 2 days ago, it was below $4. So recently just rebounded. Interesting price point is around $4.50. The company was able to raise, if I remember correctly, 800 million in corporate debt. So credit analysts and investors were at least happy with the valuation of around $4.50, $4.80 per share. From here, as I say, the net debt is minimal. It's de minimis on this thing, which is very, very strange considering it's such a massive company. It's $2.9 billion market cap. It's not a small cap. It's not a small cap. It's not a micro cap, at least, which you expect to see in some of these early stage explorers and developers. This is an in production company. It's a mature company. So if we take a look here, this is extremely rough, but it will get my point across. Here we've got estimates for the company's mineral reserves and resources. Resources, who knows? Reserves, I have more confidence. So if we were to take these numbers just to work our way through and say there's inventory in the ground, we think 55 million ounces of platinum group metals, and I would have priced that at $1,000 an ounce, which is, I think you'd agree, very conservative. That suggests a $55 billion valuation of those metals. Now, obviously, there's a big cost and there's a discount needed to be applied because it's going to take time and a lot of money to extract those metals. I have seen several hedge funds and several different people much smarter than I saying that in a bull market previously, these types of metals in situ deposits have been valued at around 20% of the value of the in the ground metal. So it is rough, but what if we were to value the expected inventory at about a fifth of its current price or pricing at $1,000 an ounce? That suggests for the platinum group metals alone, there's $11 billion worth after extraction, if you were to take that value at 20 cents on the dollar. Same thing applies, 5.5 million, but with the gold, I've used a gold price of 2,000 an ounce. I don't think that's particularly unreasonable. Obviously, you can do your own math there and play around with the pricing. Suggests 5.5 billion, and if we value that at 20%, there's about $1 billion worth of precious metals, gold in this case. And then we've got the 60 million random pounds of uranium there. I value that at about 70, because you certainly don't want to use the current price at about $100 or $94 a pound. That's a long way north of where incentive price is. I think incentive price is somewhere around $70 for uranium. So I've used that, and then I've, again, just valued it at 20%. That suggests, very conservatively, I would say, $12.84 billion worth of reserve values versus a market cap today of less than $3 billion. If you were, again, to discount it again, that defeats the purpose of using the 20% formula. But to really ram the point home, if that were to take 3 years and you were only going to get a fifth of that valuation, and you had to wait 3 years and you wanted to discount that at 14%, 10%, and then allowing for some corporate taxes, it's so absurd that would be considered around about $4.9 billion worth of metals in the ground, extremely conservatively valued at 20% of what we think is there, and discounted again at 14% for 3 years. So that would suggest a decent upside, a really decent upside from here, just from where we are. Now, if you're watching this and you see the graphic and you say, okay, that's fine, Ben, but what about South Africa? Like, what if this thing really just, it's hard to imagine it getting worse, but what if it does get worse? What if the South Africa just ceases to exist and there's no production coming out of South Africa for who knows what, for the rest of time? Well, let's ignore the South African deposits then, and let's ignore what would happen to the pricing of platinum and palladium deposits around the world outside South Africa when you consider that a huge supply would all of a sudden be offline. And let's say, okay, what are the US deposits and what would they be worth? So if we take 26.3 billion, or if we take the ounces and value that at $1,000 an ounce, you get to roughly 26.3 billion. You discount similar way at 20%. It suggests only the US deposits alone for the platinum group metals sits at around 5.2 billion. Okay, so somewhere around a 40% upside from here. Very conservative pricing. If we had this reversion to NAV, let's call it, or asset value, offering 40% on the assets outside of South Africa alone, and you had a massive call option on a platinum bull market plus uranium, to me, that is interesting, and that is a margin of safety. It's not to say this will be for the faint of heart. It's not to say things can't go wrong. Of course they can, but it's enough to get me involved. If you look at earnings, I think there's a wrong way to value this right now. That's not the way I'm looking at it. But I want to illustrate here. If you look at analysts' expected earnings for the rest of this year, it's expected to be flat in this price environment and with some of the problems that the company has. You're looking at these multiples, at these estimates of EBITDA and earnings per share, and an equally weighted average of around $3.25, which is a long way below where we are now. If we were to get to low threes, I would be significantly increasing my holdings personally. It's not a recommendation. So there you have it. That's my view and my thoughts on Sibanye. I've taken a while to really think about this, and I am long the stock in various ways. I'm long options, which you can see in the Maverick Live portfolio, link in the description. I'm long also in my publicly viewable eToro portfolio. So 5% potentially going overweight. I think it's the talkiest of the talkiest majors, let's call it, when looking to play a rebound in the platinum group metals. So thank you very much for watching. I hope you enjoyed. Please do like and subscribe to the YouTube channel. That helps with the algorithms, and I'll see you in another video shortly. Take care, guys.